Liquidity, a trading concept that makes or breaks your trading and a concept that many traders struggle to understand. This video will finally make you understand all of it so you can get simple and clean setups like this one. So let's get into it. Starting from the fundamental concepts of this video, the concept number 1. This is a pretty simple concept. We are talking about what is liquidity, and what does liquidity do, or how does it impact the markets. We first have to understand what exactly is liquidity. So what does it mean? Because you might probably have heard of it before. Liquidity in trading essentially refers to money in form of pending orders. So when we want to identify areas of liquidity, we need to ask ourselves, where is the money? And money in the markets can only come in the form of 3 different ways. It can only come in the form of entry orders, stop-loss orders, and take-profit orders. Every time you get an entry, you place or take liquidity into the market. And every time the price hits your stop-loss, you place or take liquidity into the market. And also every time the price hits your take-profit, you place or take liquidity into the market. Now these order levels are actually pretty commonly known between traders. So when asking yourself how to identify key areas of liquidity, what you really need to ask yourself is, where are the orders of the other traders? And as I said before, it's actually not that hard to identify that. Because of human psychology, we can assume visually where most traders have placed their entries, stop losses, and take profits. And that is exactly what we are going to talk about in this simple diagram. So this price action presentation is crucial in understanding the most common liquidity concept, which is retail money. What we want to think is, where is everybody's stop losses? Basically, where are their orders placed? And if any of these retail traders are holding profitable positions, where are these traders looking to take profits? Liquidity is mostly based on psychology. You should understand that many traders are trading similar price levels. They bring a pool of liquidity in some price levels in which the smart money can use that liquidity to move the markets into their advantage. And we can identify the strategies they use and finally understand where is all the liquidity. So simply explained, if we know that liquidity comes from stop losses, entries, and take profits, we need to identify where are people putting their orders. So here are some very simple ideas of how we can identify some liquidity. Then we will take a look at what this looks like in the actual market. So here we have a push to the upside, followed by a pullback to the downside. And again, push to the upside, which is shortly followed by another downwards pullback. So at the first view, we would say this market is following an uptrend, being a bullish market that steadily increases. But there is also an ascending trend line forming from each of the swing lows down here. And usually there are a lot of retail traders that are looking at patterns like trend lines. These trendline traders are usually positioning themselves to buy long on multiple hits of the trend line, so they basically want to continue trading higher. And their most common entry level based on their strategy is to enter the trade somewhere near these levels in here. They also usually place their stop loss below the last swing low. And where do you think it's more likely they will place their take profit targets? Well, usually above the highs in this case, because it's a psychological levels. Now you can also think about your own placements. Probably you had similar levels that you were looking at. Many traders view the market in the same way. And it's also sort of logical we would place our stop loss below the lows, because in bullish markets, the lows should hold up and not break to the downside. And the similar mindset goes on for the take profit. At some sort of swing high you think should be rejected. So this is how a trendline retail trader would view this market. Then we have the opposite way of thinking. This is how a more experienced trader would view this market. This type of trader says, well, the market has been trading higher and higher for a long amount of time, and we begin to reject this price level. And then the price has pulled back into this same area and rejected it once again. So that shows us that this is an area of resistance. Basically an area that is protected. So we would like to look for some sort of sell short setup in this case. So this smarter type of trader might place his entries up at this level. When price comes back, they're probably going to place their stop loss near the highs, up in this level. And then they're probably going to place their take profit near some of the previous lows. So far we observe these 2 types of traders. One is looking to buy long because of this trend line, and the other trader is looking to sell short because he knows some market structure fundamentals and is able to see that the highs are starting to reject, meaning that buying momentum is decreasing while selling momentum is increasing. There are many types of traders, as we've said before, but these are the most common ones. There's also another one that is met frequently, and that is the breakout trader. The breakout trader in this chart presentation will want to buy long the market after breaking into new highs. And there is also the other side of the breakout trader that sees a downwards trend instead of an upwards trend. And this bearish bias trader will probably look to sell short when the market breaks down below the lows. Now, why have talked about these type of traders? Well, because it's crucial to understand each view of the market, because how the markets work is basically taking liquidity traders just to give it to the others. For example, I'm sure you have met this type of situation, where you buy long at a certain price level, and the market just stops you out of the position, just for the market to continue to move into the take profit after your position has been stopped out. Well, this happens because you have been trapped by whoever moves the market. They used your liquidity in order for them to either add to their positions or for them to take profits. Both by using your stop loss. So best way to avoid getting trapped is to simply just follow the footsteps the smart money prints into the chart. And one of these footsteps is the directional bias of the market. These footsteps can't be hidden away from the rest of us, because when you move the market as a market maker, everyone will be able to see the move on the chart. But only a few traders will actually understand how to properly use that in their advantage. For example, we can easily see how the market forms swing higher lows and swing higher highs. So the directional bias of this market is bullish. On bullish markets, we look to plan buy long setups and not selling short because it does not make sense. Now, the second important footstep is to combine liquidity concepts with market structure. Now that we have talked about the probability of where those type of retail traders would place their orders, we can easily see the trend line as a liquidity target to get stopped out. Then we also have this internal higher-low structure as a potential liquidity area. And we also have the somewhat equal high seen as liquidity levels. Now we need to ask ourselves, where is a price level that follows the directional bias of a buy-long setup, while also waiting for traders to get liquidated? This is the part of setup identification, and that price level is right here, being a demand zone. So what we would want to see is the market going right into the other traders' stop losses, breaking down below the lows, and below trend line, taking all of that liquidity. Then we closely look at the price if it moves into the demand zone. On the demand, we want to wait for a confirmation that smart money are entering similar positions to us. This confirmation usually comes in form of an internal bullish market structure shift towards the bullish side. Then we can look for buy-long setups, and we are going to talk more in detail about this on live charts. The market shift, which is then followed by a constant formation of bullish breaks of structure, moving the market slowly into new highs to finally take out the liquidity of the other traders, which are the breakout traders. Moment where we can take profit from the buy-long position. Now, if the market follows a downtrend, the same thinking is applied just to the other side, and instead of a demand, we have a supply that we look to sell short after retail traders have been stopped out of their positions. So now let's talk about the biggest problem traders face on properly trading liquidity concepts. So let's see on this market, for example. We have liquidity in form of this equal lows. We have liquidity in form of this internal trend line. We have liquidity in form of a larger, more macro trend line, also in form of these equal lows, and these equal highs. Now, the problem that even advanced traders face is the following. They choose the liquidity points they want to follow, randomly, without any context. First, we always start by understanding the directional bias of the market. And on this market, we have a bullish bias. So the liquidity hunts we look for are to the downside, because often, the market makers, if they show an intention of holding a bullish market, before the upside move, you will likely see a liquidation of lows. The higher liquidity points are great for take profit levels, but not as entry levels, so keep that in mind. The next key important concept in understanding how to properly use liquidity concepts is to only consider liquidity points that are situated on the most recent swing trading range. So we take the most recent swing low and connect it with the most recent swing high. And this is the most recent trading range we are able to see on this price action. Now, if we combine market structure with liquidity concepts, we would want to buy long this market based on the bullish directional bias. But adding details about liquidity, we consider the most recent key levels as the most important ones, being these equal lows, and these equal highs, Now, if we expect a continuation of the uptrend, the higher probability move is that the market will first take out the liquidity of the equal lows. Moment where we look for setup that goes towards the buy side. A structure that would do that is a demand zone below the taken liquidity. Moment where we look to place buy long orders, with stop loss below the swing lows, and take profit above the equal highs. Basically closing the positions at the next liquidity levels on the most recent price action. Also, some might question, when do we use the lower side liquidity? Well, we use those levels only if the market fails to hold the uptrend and it moves towards the lows, essentially going back into the old lower swing trading ranges. So now before going into chart backtesting, we need to make sure everyone understands by doing a quick recap on a new example. So on this market structure, we've got a swing high right here, then a swing low. A pullback to the upside, marking another swing high. But it didn't break above the last swing high, meaning this is swing lower high, which is then followed by a significant downwards movement. A movement that finally forms a new swing low, lower than the previous one. So for the first step, what is the directional bias of the market? Based on the analysis we've done, the market is following a macro downtrend bearish trend. In bearish trends, we look for sell-short setups. So what we need to pay attention towards is the formed supply. Now we can see that initially the market has hit the supply earlier, but it has failed to form a reversal pattern, and instead it has formed equal highs. These equal highs are the liquidity that gets taken out afterwards. Remember that if the market makers want a downtrend, they will first push the market to the upside to trap traders. So after breaking the equal highs is where we can actually look for a better sell setup. And where is the other liquidity level where we can close this position? It is near the swing lows. This type of price action is met pretty often, with the smart money creating a manipulation move giving the impression of traders that the market is going to continue higher. Then they distribute downwards with the liquidity taken from the stopped-out traders. So finally, we apply everything that we have talked about into the charts. In this market, at this certain period of time, we can spot on from the first sight a descending market structure, with simple formations of swing lower highs and swing lower lows. So the step in which we analyze directional bias has been checked. We are bearish biased because the market is currently following a downtrend. Now we can move into the next step and identify key liquidity levels. On this backtest, I will also talk about the last liquidity levels that were relevant in the past. This way, you can improve your skills. So right here where we marked with a line, we got sort of an equal high formation. We can see that the price rejected from this first hit. Then it broke out with a wick, but quickly went down again. And here finally, it broke out of the range. Now this break that formed new highs took all of the liquidity from those levels. Liquidity hunts usually have pretty weird wicks that don't respect the main trend, similar to this one. So all of the traders that had sold short the equal highs, with stop losses above the highs, which is a psychological level, all of those positions have been liquidated. And what does it happen next? It reverses back down, moving into the direction that sellers initially wanted, but after stopping them out. Now the upcoming liquidity sweeps are right at these two highs, where the market has tried to break above and has done it successfully. But unfortunately for bullish bias traders, the market failed to continue, and it pulled right back down, taking more of traders' liquidity. There is also liquidity in form of a support and resistance. We can see here the first hit, then the second one from where the price bounces up. This is what these type of traders do. They usually buy support areas with stop losses below the support, and we see on the next support hit that it broke down below the support, again, taking more stop losses. And the last hit of the support, it actually flipped into a resistance and it respected. They sometimes work, however most of the times they will not respect properly. So now we see how this entire support resistance area was full of liquidity and is a key level. But traders that trade only support resistance zones based on retests have got a great and simple setup, because after breaking down the support and forming the swing low, the pullback moves the market into the previous support area, but a broken support flips into a resistance. And this time, it has worked out. The last time the traders that tried this type of setup got stopped out. Both traders, buyers, because the market continued to push lower, and sellers, because the pullback that drove the market to the upside. On this price action, we also have liquidity in form of a descending trend line, as seen right here. And now looking at the most recent price action, we should be able to identify a supply zone. A supply zone is the last candles before an impulsive move to the downside, but it is only validated if the market follows a downtrend. So we do not look for supply zones in uptrend, just the same as we don't look for demand zones in downtrend. Anyway, so this supply is our sell short setup. So let's zoom in further. If you remember the trendline liquidity, which is still untouched yet, there must be a lot of pending orders all above the trend line. So the position planning is done like this. Sell short on the supply, with the stop loss above the swing highs, because we are expecting the market to break up the trend line, taking the liquidity of traders, but without breaking the bearish market structure. And for the take profit, it should be around the lows, if not slightly lower. Basically applying the logic that if the smart money wants the market lower, they will first move the market upwards to take liquidity and push the market to the downside afterwards. And that was the setup. A simple and clear setup that took 3 hours from start to finish. This was more of an intraday or swing type of setup on this time frame. Into another example. In here we got a past uptrend formation that turned into a downtrend. But before reversing the trend, the market took out the liquidity of the past highs with an upwards wick. After it took the liquidity from the highs, the market started a downtrend formation, a simple structure of swing lower lows and swing lower highs. Another important liquidity level we need to carefully watch is the following descending trend line, because the trend line has a lot of resting liquidity above. The reason is that the trend line traders on downside trend lines, they sell short on the retest. With their stop loss placements above the trend line, they are basically expecting that the market will not break above the trend line. But we know that it will eventually, because the market can't just give out simple positions like these ones, multiple times in a row. We can see that that type of trading has worked a couple of times here, and the fact that it has worked makes more traders see this and execute on the same position. So there must be a lot of liquidity above. Also, there must be a pool of liquidity in form of stop losses above the swing highs. These are the levels where sellers are likely to place their stop losses. So the directional bias is towards the bearish side. But before bringing the price even lower, the market must take out liquidity from above in order to have enough strength to continue the downside momentum. Understanding this concept, we can look for structures that can help us to enter sell short positions. One of the most visible and safer structure is a supply zone from the top of the market, from right where the market has initiated the reversal from an uptrend into a downtrend. So the market has pushed right into the supply zone, and basically it took out all of the stop losses form above the trend line, and as well as the stop losses from the swing highs. Now we have multiple options to plan the entry. We can enter right here, or if we want to refine the setup even more, we can zoom into a lower time frame. Let's say that from the 5-minute time frame where we are in right now, we will move into the 1-minute time frame in order to see the price action with better details. So in here on the 1-minute time frame, if we identify potential liquidity areas, one of them is the supply that just has been hit. And now the most recent one is the low of the move that caused the upwards push. Greedy buyers having their stops below the lows, and the market shortly takes them out of their positions. Now we can look here for the setup after liquidity has been taken from both sides. One entry structure is this small imbalance. And it hit the imbalance, giving us a sell short opportunity, with stop loss around above the imbalance, but slightly above to not have the stop loss too tight or close to the entry. And for the take profit, we look for liquidity levels where we can close the positions. There are multiple levels, usually the swing lows. In this case, let's try to get the lowest level possible, which is this one. And that was surprisingly quick and simple. Usually we will get more complex and longer setups, so let's practice some more. On this market, we clearly observe a significant uptrend without any kind of important pullback, so a very aggressive upwards movement, meaning we got a bullish directional bias. Now for the liquidity levels, here we got an imbalance. This imbalance got filled here, giving trades a pretty simple and straightforward buy-long setup. If you're a watcher of my channel, you probably know how to plan these type of setups. Anyway, so we got another liquidity level in form of a trend line around here. With resting liquidity below the trend line, as ascending trendline traders usually buy the touch of the trend line with the stop loss below it. So now that we've seen the most important liquidity levels so far, we also need to look for the entry model. And that is a demand zone that is situated below the fair value gap, which is a great position because the imbalance got filled, but the demand did not get filled yet, meaning that there are pending orders waiting to get filled. And on the most recent liquidity level sit the liquidation of past swing highs, with resting liquidity above that got taken out shortly after, which was then followed by a break to the downside. Right after, the market breaks down below the trend line, taking all of their stop losses, then pulls back a bit, and breaks down below the last lows, so another liquidity taken down. And because the market is near the demand, we can look for buy setups right here. Now this risk to reward ratio might seem too high for some traders, but we can also take partial profits on multiple levels. And also, to see the more detailed price action, we can zoom into a lower time frame. Now here on the 1 minute time frame, we look for the market to liquidate swing highs, then the next one. And the third important one is near the take profit. And that was it. A clean setup. Also look at how the market took out these lows right before continuation of the uptrend. Liquidations also happen in lower time frames. You just need to remember that in order to move the price to the upside, smart money often first move the market to the downside to feed the main move. Don't forget that we also have extra resources. We like to turn all kinds of traders into profitable funded traders using a simple step-by-step process. You also got my ebook on psychology included. They're both on the link in the description. Have a great trading session.